Hello everyone, in this video we're going to be going through the topics of valuation at net realizable value, relative sales value, and then purchase commitments as well. Okay, so these are basically like three separate topics. They're kind of just put together into one topic. Okay, so the first one is the valuation net realizable value. Companies may value their inventory at NRV, which is net realizable value, even if the NRV exceeds costs if certain criteria are met. So basically if a company meets all three of these criteria, they can value their inventory at NRV, even if the NRV exceeds the cost of the inventory. Okay, and that seems weird, especially if you've seen the first video or one of the videos about the LCNRV and the LCM, lower of cost or market, or lower of cost or net realizable value, where we want to value our inventory at the lower of the cost or the net realizable value. But companies are allowed to do this in very limited circumstances. Again, this is just something to be aware of. You might want to just memorize this just to know it. There's not much to know other than just this very quick couple of bullet points. But basically, if they meet these criteria, there's a controlled market where the selling price is the same for all products, there are minimal disposal costs, and the product is ready for immediate delivery. Common in such as agriculture and mining businesses, right? Because, for instance, agriculture, if you're selling like grain or wheat or something like this, right? Like all of these would be met, right? Like there would be a controlled price, like the price of grain, it's commodity, like, or wheat or whatever, like it's not going to fluctuate widely, right? There's not many disposal costs. You can get rid of it relatively easily. And then it's ready for immediate delivery. Once you have it, once it's grown and stuff like that, you can get rid of it relatively quickly. Okay. So that's just a quick conceptual note. Then down to the more substantive topics for this specific lesson. Then we have relative sales value method. This is a method of valuing assets when a company purchases multiple assets together for a single amount. This is referred to as a basket purchase or a lump sum purchase. Okay, so basically what happens in these situations is a company goes and they buy, a building and a piece of land and equipment, and they buy all this stuff together for one price. Okay, so they pay $1 million for all these different assets. Okay, but the issue, and that's called a basket purchase or a lump sum purchase. Okay. But what happens is that we have to have a way of valuing those assets. We have to have a way of determining what we're going to put on the books for those assets, right? Because we can't just say, oh, well, we're going to put it all to the land account or all to the building account or whatever, right? Because that wouldn't make sense. And so this is the way that we do it, okay? So as an example, let's say we have this company. We use this method. That's the way that we do this, and we're going to go through it, okay? So if a company pays $5 million for a building and the land the building is constructed on, the company must divide the $5 million cost between the land and the building, right? Because otherwise one would be overstated or understated or something, right? The $5 million cost would be divided based on the relative sales value of the building and the land. The sales value is essentially the fair value of the estimated selling price of the assets. Okay, so what we're going to do is we're going to use a fair value approach. Okay, so what we're going to do is that we're going to say, okay, we paid $5 million for these two assets, right? The fair value of the land might be $10 million. The fair value of the building might be, $5 million or something. Okay, and then we determine the ratio of the fair value of the building over the total fair value, and then the ratio of the land, the fair value of that over the total fair value, and then we multiply that by the $5 million to get the values. Okay, I'm just talking through that as an example. We're going to go through an actual example of numbers and how it works 100%. I just wanted to get you guys familiar with the topic. Okay. So that's how that one works. Okay, we're basically just using fair values to actually determine the value of the land and the building. Okay. Then we have a purchase commitment. Okay, this is an agreement to buy inventory at some point in time, at some point in the future. Companies enter into purchase commitments to ensure that they will have inventory to sell and to hedge against potential increases in price. Generally, companies do not record any journal entries related to purchase commitments. Okay, so like, as a general rule, if you have a purchase commitment, companies are not going to actually record journal entries, but there is an exception that says if the purchase commitment is non-cancelable and at year end, the contract price is greater than the market price, the company must record any losses it expects to incur in the future related to the purchase commitment as soon as the company expects to incur the loss. Okay, so basically what that means is, generally speaking, if we just have these contracts, and we can cancel them and they're whatever, then we don't need to worry about them. That's the general rule. The exception is like if we have this non-cancelable contract, right, where we can't cancel it, right? That's what that means. We have to go through with it. Then if we have this situation where the contract price is greater than the market price, we have to record a loss, okay? And why are we recording a loss? It's because, like, for instance, the contract price might be $1, and then we're required to pay $1. If the market price is then 50 cents, okay, we kind of get screwed, right? Because we could have paid 50 cents if we were not in this contract, right? But now we're forced to pay $1 for this product, okay? So that's a loss to us, right? Because we were almost like, we just got screwed by the market, basically. Okay, it's called the market moves against you. That's what it's called when you end up losing out on these contracts, okay? So basically, the loss the company records is an unrealized holding loss, and it is shown on the other expenses and losses section of the income statement, okay? So basically, when we record this loss, it's basically an unrealized holding loss, okay? And it is shown on the other expenses and losses section of the income statement. Now, the company is allowed to record a recovery of the loss in future periods. And then finally, companies can hedge their exposure to market fluctuations by purchasing a sell position, which allows a company to capitalize on declines in market prices. This is just a conceptual point. Just memorize that. What that exactly means doesn't really matter for this class, but I just included in there for completeness purposes, just in case it were to show up somewhere and you would need to know that. But I would just memorize this part and not really worry too much about the specifics of that, because that's getting into basically a lot more advanced topics that are beyond the scope of the class. Okay, so that's just a quick introduction. Now we're gonna go through some problems. So the first one is for relative sales value. Okay, so XYZ company recently completed a lump sum purchase where it bought some equipment, land, and a building for $2 million cash. So they bought 3 assets for $2 million cash. This is, once you see these problems can have very similar fact patterns, okay? And the thing about it is they're going to give you like the same information. It's basically be like, okay, they bought a bunch of assets for one price, and then it's going to tell you this next information, which is the following information is available concerning these 3 things. It's going to tell you the estimated selling price or the fair value. It's going to tell you something like that for all of these different items, okay? So once you see a problem like this, you should be thinking, oh, okay, this is relative sales value, because these problems are very distinct. They're always set up in this way. There's not much other way that they can be set up. Okay, it's generally like we bought some stuff together, and then here's the fair values. Okay, prepare the journal entry to record the cost of the equipment, land, and building. Okay, so now we have to determine how to do this. Again, like we said, we're going to use these estimated selling prices. So what we do is that we basically want to just set up a chart. Okay, so we say equipment, land, and building. Okay. The estimated sales price is $600,000, $700,000, and then $1.2 million for these 3 pieces for the equipment, for the land, and the building, right? Which means we have a total of $2.5 million. Okay. Then what we want to do, and again, it's called relative sales value, right? So what we want to do is we want to get the relative sales price. So what we do for each one of these is we take the $600,000, we divide by $2.5 million, we get 0.24. We take the $700,000, divide by $2.5 million, 0.28. 1.2 million divided by 2.5 million. 0.48, okay? That's the way that we get these ratios, okay? That's the relative sales value, right? That's the portion of the sales value that each one represents out of the total sales value, okay? Then what you do, the very last step is that to get this 480 is that you take 0.24 and then you multiply by 2 million, okay? And that gives you $480,000. And then you do that the same across. You do 0.28, you multiply it by $2 million, okay? That gives you the 560. 0.48 times 2 million, 960. Okay, so basically that's the way that you do these problems. You basically determine all the sales values, add them up, determine your relative sales price, then just simply multiply the relative sales price by the total cash price that you paid, and then you get the cost allocated. And then the journal entry is very easy because the cash is going to go out at 2 million, and these are our numbers for our journal entry. Equipment 480, land 560, building 960. Okay, that's literally that simple. So it's not too bad. These problems are relatively straightforward. You just have to kind of get them down, and then they kind of all become the same thing. Okay, that was relative sales value. Then we're going to go through a purchase commitment. This one's relatively extensive. It's got, I think a couple of years or something like this. Okay, so let's see. So ABC company is in the business of making electronics and needs a constant supply of copper. To ensure it will have copper for the next year, on November 1st of 2017, the company signs a purchase commitment to buy 1,000 pounds of copper for $1 a pound on March 1st of 2018. So that's next year, right? For $1 a pound, right? This purchase commitment is non-cancelable by either ABC or the supplier of the copper. So now we're in the situation where we're thinking, okay, this is non-cancelable. if the market price is basically lower than the contract price is higher than the market price, however you want to look at it, means the same thing, right? Then we need to record a loss at year end, right? So that's what we need to be thinking is, okay, once it's non-cancelable, is there a loss at year end? Okay. So then at December 31 of 2017, the market price for copper is 90 cents a pound. Well, we see there is a loss, right? Because in this case, we actually have to pay $1, but we could have paid 90 cents, right, if we were not in this contract. So in that case, again, we kind of lost. We got screwed by the market to a certain extent, right? Because basically, we would be allowed to buy this for 90 cents, but if we were not in this contract, but we are in the contract, we must pay $1, okay? So we lose by 10 cents per pound, okay? Then on February 1 of 2018, the copper price increases to 95 cents and then remains at that level until we buy it on March 1st, okay? So then it says, prepare all the necessary entries to record the events surrounding ABC's purchase commitment for the years ended December 31, 2017 and December 31 of 2018. If no entry is necessary, write no entry. Okay, so November 1st of 2017, that's when they signed the contract. The entry there is no entry, okay? You never have an entry on the first date. Like, you pretty much never do. It's just not something that really happens, okay? There's nothing to record, basically, okay? So no entry on November 1st of 2017. Then we have, again, we talked about it before, on December 31, that's their year end, okay? This company incurs a loss, right? We just talked about it. They incur a loss of 10 cents per pound, right? Because they have to pay $1, but they would be able to pay 90 cents. So the loss is 10 cents per pound. They basically have to pay 10 cents more than they would have if they just bought it from the market at the current market price, right? But that's 10 cents per pound. Then we have to multiply by 100,000 pounds. That gives us $10,000 loss, okay? So again, as we talked about before, we debit this account called UHGL-income, unrealized holding gain loss income. It's a loss, okay? Again, this is UHGL-income. Okay, that's generally acceptable. Again, ask your professor, make sure, but generally that's an acceptable abbreviation. Okay, so that'll be for $10,000. And then we have to credit estimated liability on purchase commitments. Okay, we're basically recording a liability here to show that, okay, well, we have a loss and we need a credit. Okay, and the thing that makes sense to credit here is something like a liability. Okay, so we just credit this liability on purchase commitments for $10,000 as well. Okay, then on February 1 of 2018, again, the price goes up to 95 cents. So that actually helps us, right? Because now we're only paying 5 cents more than we're supposed to, right? Because if we bought it from the market on February 1st, we'd pay 95 cents. However, we're forced to pay $1, right? So in this case, now we're paying 5 cents more per pound, but it's better than paying 10 cents more per pound, right? As we were on December 31. So as it says on the first page, okay, it says the company is allowed to record a recovery of loss in future periods, okay? And so this is the recovery of the loss. What we're going to do is that we're going to credit UHGL income, okay, which is basically the recovery of the loss, and then we're going to reduce this estimated liability, okay? And we reduce it. Basically, the way that we do that is that we say, okay, well, the change was, it used to be 10 cents, right? Now it's only 5 cents more, okay? So that means that we recovered 5 cents times $100,000. 5 cents per pound times 100,000 pounds gives us $5,000. Okay. Then we have March 1st of 2018. The thing that we're going to do here is we're actually going to settle the contract, right? Okay. So in this case, we are going to end up in a situation where we're going to have to pay out cash of $100,000, right? Because we have to buy 100,000 pounds at $1 per pound. That's the contract that we signed. We have to honor that contract. Okay. Then what we do is that we take off this estimated liability. It still has 5,000, right? Because we recorded 10,000 at December 31. We took off 5,000 on February 1st. That means we have 5,000 left. So we take out 5,000 out of the estimated liability on purchase commitments, and then whatever the balance is, it goes to inventory or purchases, whichever one. It depends on if you're using periodic or perpetual inventory, right? Purchases would be periodic. Perpetual inventory would use the inventory account. But basically that's what it does. So this estimated liability, it reduces the amount that you actually put into your inventory or purchases account. Okay, so that's the first part from above. Now what we're going to do is that we're going to just assume the same facts, except for the fact that now on February 1st of 2018, the copper price actually goes down to 85 cents. Okay, so now it says, again, just prepare the journal entries for 2017, 2018. If there's no entry required, write no entry. Okay, so November 1st, 2017, okay, no entry is required. Okay, so basically in that case, we write no entry. Okay, then December 31, 2017, nothing changed there, so it's literally the same journal entry. We don't necessarily need to go through that again, okay, because we've already gone through that extensively in the first part of the problem. The thing that changes is these two entries here. Let's focus here, okay? So February 1, the price goes down to 85 cents. So now we actually have to pay, $1, but we would have been able to pay 85 cents, okay? So now we're actually getting screwed by 15 cents per pound. Okay, so that's actually even worse because than December 31, right? December 31, we were going to pay 10 cents more per pound, okay, which is bad, but 15 cents per pound more than what we're supposed to pay than the market is even worse, right? So now we're actually going to lose out by an additional 5 cents, right? Because we already lost out by 10, we already recorded that loss. Now we have to record an additional 5 cent loss because we're overall losing by 15 cents. We've already recorded 10 cents per pound. Now we need to record an additional 5 cents per pound. So 5 cents per pound times 100,000 pounds, $5,000 loss. Okay, so it'll be UHGL income, 5,000. Estimated liability on purchase commitments goes up by 5,000. Okay, so now we have $15,000 of purchase commitment and we've recorded 15,000 of loss. Okay, now from March 1st comes around, again, we have to pay out the same 100,000 of cash. The only thing that's going to change now is that the estimated liability on purchase commitments is 15 and then the purchase inventory account is 85. Okay, so again, we remove this account, and then whatever's left goes to the purchases or inventory account. Okay, so this is basically to show that it can go either way, right? It could be a situation where we record a recovery of a loss on the next year, okay, and that actually kind of helps us out, and we actually don't have to record as much of a loss, and we record less of a liability, okay? But in this case, it can actually get worse, right? So that means that the loss can get even bigger, and then we'll have to record an additional 5,000 of loss, okay? And so basically, these two different scenarios are basically just to demonstrate the journal entries for those two different scenarios. So that is the end of this topic, and I hope that was helpful.